Let's go. Thank you so much for showing up today on your lunch. And I hope that I'll be able to pack it filled with a lot of knowledge and education for you. If I can just get in the chat, everybody to just tap in there where you guys are logging in from, what city, what town, what country. You can get some activity in the chat. It's all about participation. Hello. I see you, Kevin. I see you, Mark. All right. So yes, if I can get everybody in the chat. I see you're from Toronto. Okay, good. Toronto people in the house. Great. Great. All right. So we're all on the pretty much the same time zone here. So let me go ahead and share my screen. I'm going to get started. And just before I do that, I just want to share a little bit about myself. So my name's Kyla, and I have been doing, I just got into infinite banking about 6 years ago, and it really changed my life. And my background previous to that was in real estate. So I started in real estate, and then I moved from real estate, being a real estate agent, over to being a mortgage broker. And then from being a mortgage broker, I also became an investor and property manager. And then from there, I got into insurance with infinite banking. So this is where I am now. I have all that background. I still do, mortgages. I still hold my license there as well as my insurance license. But on the real estate side, I no longer show people houses, but I do some investments, and I have some rental properties. So let's get right into it, and we can go from there. Hope you guys are excited. This is great information, and I'm glad everybody is here and able to participate. So obviously you can ask some questions in the chat, and feel free to, So I'm going to go ahead and present this. So infinite banking concept, becoming your own. Give a little disclaimer here that this is for education purposes, and that you should consult with your financial advisor, mortgage broker, insurance agent. And this is not deemed financial advice. You can also check with your lawyer or your accountant. And this is just for educational purposes only. All right, so let's go ahead. So becoming your own banker. So how to control your wealth. This is the first step, right? So we create wealth. It's important. It's very taboo in Canada to talk about wealth, but I'm going to be talking about it because it's important to talk about. So creating wealth starts from income, your income. And that's either your job, your business, your pension, retirement, or if you're lucky, inheritance. There's other ways to get income, but we'll stick with that. So you create the wealth, you receive your paycheck, monthly, biweekly, the money you receive. There's 4 things you do with it. So you could save it in the bank, you can invest it, however you decide, spend it, or you can give it away. And I'm sure we do pretty much all of those things. So what about before you use the income? To do those things, you first put it in an area where you completely have control over it, and we call that becoming bankers. So it's a vehicle, a tool, a piggy bank. So when you become a banker, you earn dividends. You have guaranteed growth, which is tax-free. You can leverage it, invest it in more than one place, and at the same time, you receive protection in the form of a death benefit. So in case you die, in case any individual tries to sue you, you're protected. So this is a wonderful thing to be able to do, to become a banker, or to do the banking function by having this tool. All right. So how to control your wealth? How do we do that? So by becoming bankers, there's no losses whatsoever. There's zero market volatility. What? Yes, zero market volatility. So this doesn't go up and down with the stock markets. It has a guaranteed return. It's a wonderful asset. And since money attracts opportunities, opportunities will locate you because your money will be piling up in your new tool, your new piggy bank. Okay, you can use the cash for investments or huge purchases, such as buying a car or paying college fees. And then you are now your own banker. So you have full control over your finances. So what do we mean here? Let's break it down so that you guys can all understand what is infinite banking, who is infinite banking for, and how does infinite banking work. Also, we're going to discuss today what is the link between infinite banking and whole life insurance policies, and what are the pros and cons of infinite banking. All right, so infinite banking is very popular in America, but it's not so popular in Canada. And we're trying to give people education and knowledge to be able to access this tool and use it in their lives and become aware of it. Okay, so infinite banking is about becoming your own banker. So rather than saving and borrowing cash from traditional banks and inside the traditional banks, which you probably do right now, you put your money in there and then you send it away to somebody else's family, right? We're going to show you that infinite banking is made possible by purchasing a whole life insurance policy. Then we use that policy as the vehicle. This is the vehicle that is your own banking system if you implement the banking function properly. And it's a tax-free vehicle for holding your money. So as the cash value of your policy increases, you can access it at any time by borrowing against the money inside your policy that is growing in the back end inside your piggy bank. Okay. So let's go on. Let's talk about the background of infinite banking. So the infinite banking concept was created by the late and great Nelson Nash during 1980. So this has been around for a little while. And Nash was a finance expert, and he followed the Austrian School of Economics, which advocates that the value of goods aren't explicitly the result of traditional economic structures such as demand and supply, and instead people need to use the money for how they decide to use it. So everybody has a different need for money, and you get to decide how you use your money, whether you want a lot, whether you want a little, whatever you're satisfied with is what he structured this on. So following this thought, Nelsh developed the idea of individuals becoming their own bankers to better you're able to keep your money inside your individual banking system. So Nash talks about this concept in his book, Becoming Your Own Banker. Thank you, Nelson Nash. You changed my life. I read that book about 7 years ago, and I got started with the infinite banking concept. Thank you to Nelson Nash. Okay, so according to Nelson Nash, one of the pitfalls of traditional banking was high interest rates on loans. So that's going on right now, right? High interest rates, it is a pitfall. People are feeling it when they have mortgages, when they have car loans, when they have credit cards, the interest rates are very high. So many people, including himself, found themselves in financial crisis because they over relied on banking institutions. And because banks set their own interest rates and loan terms, people don't have control over their own wealth. Therefore, Nash determined that becoming your own banker would give you control over your financial future. However, you need a specific type of whole life insurance for infinite banking to work. So this is the piggy bank, and this is the tool that you're now going to be using when you want to create the banking function in your life. And it's always said that those who have the gold make the rules. So if you're putting your gold in another institution like traditional financing institutions, they're the ones who have your gold and they're the ones who make the rules when they lend it back to you. Instead, you can put the money and your gold into your piggy bank and you will have the gold and make the rules. So let's keep going. This is Nelson Nash. Oh, thank you, Nelson. Really appreciate him. He was a great man. He passed away about 2 years ago. And he has left this for many people to be able to catch the concept, okay? You got to catch it like a softball, all right? So let's keep going on. So hopefully you can catch it this time. If not, we'll just keep on going. You can read the book and you can probably catch it from there, even if you have to read it 1, 2, 3, 4 times. There's people that read it every year and sometimes every week. So let's go on. So the very first principle that you must be understood is that you finance everything that you buy, and you pay interest to somebody else or you give up interest that you could have earned otherwise. And this is from straight from Nelson Nash's mouth. And he's the creator of the infinite banking concept. So thank you. Round of applause to him. And I'm going to repeat it because it's very important to catch this. And please write this down if you have a pen. The very first principle that you must understand is that you finance everything that you buy. And you're going to pay interest to somebody else, or if you pay cash, guess what? You're giving up interest that you could have earned otherwise. All right, so I hope you guys got that. Take a screenshot. I'm going to keep going. All right, so insurance. So to appreciate IBC, we first need to look at the different types of insurance because there's different types. And term insurance is the first one we're going to look at for life insurance. Let's compare it. We'll compare it with fire insurance. A homeowner pays premiums to the insurance company, and in case of a fire, the homeowner gets a check to cover the damages, right? So if your house burns down, I've seen people's house burn down, or you have a flood in your basement, the insurance company is going to give you the money to fix it up. And that's it. They're not giving you any extra cash or anything like that. So this did happen to me. I'll give you an example. I had a flood in my basement, and the insurance company just gave me the bare minimum to bring it back to how it was, the standard. But I had an in-law suite, and because, there was some plumbing being done to ensure that the flood never happened again, the city came in to inspect, and then they're like, oh, it's an in-law suite. You have to make this legal. Now, obviously, you have to get drawings. You have to do all kinds of extra work. The insurance company will not cover that. They're just like, yeah, we're going to put back your drywall, your floors, and whatever else got damaged. That whole extra piece about compliance with the city and changing it to a duplex, that was on me. So luckily, I had my own banking system that had been building for a couple of years. I was able to borrow from myself and do all the repairs and do all the upgrades to make sure that it met the code of the city and was able to become a legal duplex. So unlike regular term insurance, they only cover the pure cost of the premium. Same with car insurance. Hey, who hasn't been in an accident? I have. I mean, all you good drivers out there, good for you. But I have been in an accident. Thank God it was a long time ago. But when I hit the car, it was really scary. And the insurance company, thank God they were there. They were able to fix the car with the insurance money. But they didn't give me extra money like, hey, you got injured. Let's give you a little extra money to hold in your pocket while you get through this. No, they just gave you the cost of the money to fix your car. Okay. So in this case, the premium that you pay is only covering the pure cost of the insurance. You're not getting any cash back other than the pure cost of insurance just to repair either the house or the car. So let's go on. If the person lives throughout the full term specified in the initial contract, then the contract ends and the holder must reapply for another policy. So that's for term insurance. The same thing with your car. If you go through 1 year, then you have to do another contract for another year. So every year, the price usually goes up, but they'll send you a new contract for the house and the car. And that's the same process that applies to term life insurance. So let's say someone's 25 years old and they purchase an insurance policy which promises a $1 million whopping dollar payout. So the policy is set to operate for, let's say, 10, 20, or 30 years. And upon assessing the applicant's medical condition, because they check your medical condition at the time of applying for the insurance offers you a policy with a fixed annual or monthly premium payment. So provided the policy owner keeps paying the premiums throughout that term, then they're guaranteed the $1 million death benefit once they pass away, and it will go to their beneficiaries within that term. So nevertheless, if the policyholder lives the entire term specified in the initial contract, then the contract just ends and the individual has to reapply at a later date in life for life insurance. Or If it's too much at that time, because it's a later date and they're obviously older, maybe have some health concerns, they may have to go without. So if a person purchases a 30-year term policy at the age of 25, then at 55, the person will have to buy a new policy with obviously higher premiums and have to go through a medical again. So practically, most term life insurance policies expire without the insurance company having paid out any death benefit claim. So let's talk about whole life insurance. It's a bit different than term because it's keyword for your whole life. Okay, so the life insurance company takes the incoming premium payments and then they invest them by buying financial assets. And they're on a contractual guarantee for you. So they need to make sure that those investments are sound investments. So Nash determined that the best financial tool for infinite banking is whole life insurance. So this is the tool that we're going to use to develop the banking system, your piggy bank, and for you to be able to operate the banking function from this tool because it's for your whole life. So infinite banking is not just traditional whole life insurance. IBC works best if the banker, which would be you, employs a properly structured whole life insurance policy as your banking system. That's first. Then you also have to learn how to implement the banking function in your life to be a banker, right? So you need to learn how to borrow, how to lend, how to save, how to, repay your payments, how to be a good banker. Okay, so you can implement the banking function. If you just get a whole life insurance policy that's not properly structured and it's just sitting there, then you're not actually doing the banking function. You're not creating a banking system, but you just have the insurance policy that's growing with dividends and interest. But you do want to be a banker, right? So let's keep on going. The link between whole life insurance and infinite banking. Okay, so whole life insurance policies, they come with a cash surrender value. That's your piggy bank. This is the cash that's made liquid to you. Okay, and it's called your cash value. So the cash surrender value of your policy is the amount the death benefit. So it's part of the death benefit, like let's say it was that $1 million that you're going to get when you pass away. The insurance company makes a portion of that liquid to you right away, and that portion grows. And that portion is your piggy bank, your banking system. So in the event you cancel your policy while you're still alive, that amount that you receive from the insurance company is the cash value. So the money, I guess you call it the banking system, your piggy bank, that's the cash value. So as long as you continue to pay your premiums, the cash value of your policy can be utilized for personal and business loans using your policy as collateral. So your collateral is that piggy bank, and that is on the back end, and we don't ever touch that. That's on the back, building and growing, okay? So as opposed to term insurance, which is only meant to serve you if there's, a catastrophe or something happens, and your beneficiaries receive money after you die, whole life insurance covers you for your entire life, and you get to benefit while you're alive, and then your beneficiaries can benefit after you pass away. Okay, so that's the difference. Term insurance is just for the immediate, let's take care of that, you passed away. And then whole life is, we can actually use that while we're alive, and then your beneficiaries still benefit when you pass away. So types of whole life insurance. There's participating and non-participating whole life insurance. So this policy allows holders to participate, become a part owner of the insurance company, receive dividends, right? Because owners receive dividends at the end of the year when the company makes profits. So by using participating whole life insurance policy for infinite banking, your piggy bank, your cash value increases whenever the insurance company pays dividends. And the cash value also increases when you pay your premium and earn a guaranteed rate of interest. So you are also contractually, the insurance company is contractually obligated to you to ensure that you do earn a guaranteed interest rate. So let's see how it breaks down how our piggy bank is growing on the back end. Okay. So let me just, I'm using the word piggy bank because, if you have a piggy bank and you have a stopper in the bottom and you tape it up and you like make sure that, maybe you pour some steel on it and you make sure that nobody can take the money outside of the piggy bank. You can only put money in. This is what your banking system is doing on the back end, and it's compounding. And Albert Einstein said the eighth wonder of the world is compounding interest. Okay. So inside of your piggy bank, it's exploding. So let's just say you have a really, really big one and it's just growing on the inside there, just growing massively like a snowball, just growing as it rolls down the hill. So how it grows is one, a portion of the premiums paid comes from you. That money goes directly inside your piggy bank, right? So instead of it going to the traditional bank, it's going directly inside of your piggy bank. Then you also get guaranteed interest, and this is paid daily on the money that's inside, and it's guaranteed. The insurance company has a contractual obligation to you to make sure that they guarantee interest paid to you. 3, you get potential dividends, and that's the money from your insurance company. At the end of the year, that money dissipates down to you. Okay, so those are the 3 ways: your premiums, the interest, and the dividends. All right, let's keep going. So guaranteed cash value. So whole life insurance policies offer guaranteed cash value that grows depending on the formula determined by an insurance company. But it is guaranteed. That's why it doesn't go up and down like the stock market. Now, let me tell you, this is such a great asset that the banks will lend you on your asset, the cash value asset, your piggy bank. They're going to lend you 90% of whatever's in that asset. They'll lend up to 90%. Sometimes they'll lend even more. Now, what is the other best asset that we have? What is the other best asset? If I can get in the chat, the other best asset that most people will say is the best asset ever. I can't really see the chat. Let's just see here. Anybody? Not sure, not sure. Okay. Okay. Anybody know the other best asset? Okay. Should I give it away? What do we? It's a house, guys. Usually real estate, right? That's like, oh, everybody loves real estate. Okay, so what will the banks lend you on that real estate? If you have a, $100,000 property, they're only going to lend you 80%. 80. So which one is a better asset? The 80%? Why is it only 80? Why don't they lend you 90? Because they will lend you 90 on this asset. And there's no questions asked. It's just, hey, which account do you want it in? And how much do you want? Those are the 2 questions. But now if you go for a mortgage, how many questions are they asking you? And they ask you, hey, do you got some blood for that? Can we check your, I'm just joking. But they ask you a whole bunch of questions about your employment, your income. They ask you, what's your credit? So this is a fantastic asset because obviously the banks know this. It's guaranteed cash value. So they will give you 90% here, whereas a house, they'll give you 80% of the value. So the cash value that has built up in your policy is what the insurance company makes available and liquid to you. And, they allow you to make use of it while you're still alive through borrowing against it. And different insurance companies have a whole life cash value chart that show how guaranteed cash values accumulate over time. So you will get to see that, and it's amazing. Now we have an illustration of the guaranteed cash value chart. So again, the insurance company is contractually obligated to you to guarantee these cash values. And that's why the bank's like, yeah, we'll give you 90% on that because it is a contract. Okay, so this is for our whole life cash value for a $100,000 policy. Hey, if you guys want $1 million policy, just add an extra zero on the illustrations below. So let's just take a look here. So we have the policy year, 5 years here. Ooh, right? We got age 40. So this is a 35-year-old non-smoking male. So after 5 years, they're 40 years old. Every year, they're putting in $1,178. So after 5 years of cash value, their piggy bank, their new banking system has accumulated $3,738. So no questions asked, you're allowed to borrow 90% of this money. All right, let's fast forward. We got to year 10. We've been doing this for 10 years. This client is 45 now, and they've been putting in that $1,178 a year annual premiums. And now they have access pretty much to every dollar that they've put in. It's just a little short, but they've gotten almost every dollar back. Now the death benefit is also rising. Okay, so let's fast forward. They're now 30, age of retirement, 65. They're ready to retire. They're like, okay, yes, I've been doing this for a while now. And I'm just going to calculate quickly. How long have they been doing it? Anybody is good with math here? So 1178, and they've been doing this for 30 years. So 1178 annual premiums by 30 years. Yeah, so they've put in $35,000. Well, $35,340. But yet they have access to $72,000. So they have doubled their money, right? And like I said, if you want to put higher premiums, maybe you add an extra zero, you've been putting in $11,000 a year. Now you put in $11,000 a year for the last 30 years. You put in $350,000, but yet you have access to $720,000. So your money's almost doubled. It has doubled. Okay, so that's what we're showing you. And then let's say we're getting older now. You've been doing this for 50 years. So 1178 by 50 years, you put in $58,900. 50 years, you're 85. And you have access to $228,317. And obviously your death benefit has increased. So this is some good money right here. Like you only put in 58,000, but you have access to $228,317. So you made $169,000 just by putting in this money and using it and paying yourself back and being a good banker and learning how to do the banking function. This is what your money's doing on the back end in your piggy bank and compounding nonstop. All right. So let's keep on going. The policy loan. So as I said, we leave our money inside the piggy bank. We don't touch it. We don't take it out. We don't remove it. We take a policy loan as collateral against the money that is compounding on the back end. So you can access a cash value of your whole life insurance policy whenever you want, for whatever reason, including to purchase a home, pay tuition fees, business capital for other investments, opportunities, emergency expenses, etc. So I'll just stop here. All of these things pretty much have happened to me. And luckily I had set this in place, because otherwise I'd be, subjected to the banking terms, like traditional bank terms, if I even qualify and all of that stuff, So I've had to use it for business capital, investment opportunities. There was a time when I wanted to purchase a house, a new build house, and I was able to use my policy to put money down slowly on the down payment of the home. Again, I talked about how my basement flooded and I wasn't covered for, elevating the property to a duplex. So I was able to rely on my banking system, which was solid, and borrow the money to do these things. But However, to get the full benefit of the infinite banking concept, you have to use a policy loan instead of just withdrawing the money, because if you withdraw the money, it interrupts your compounding period. So you leave the money in and you take the policy loan against it and you pay yourself back just like you would to the regular traditional bank. You would pay them back with interest. So why wouldn't you pay yourself back with interest so that you can recapture that money? So by taking advantage of the policy loan features of your whole life insurance, your cash value keeps growing in spite of having a loan. Okay. So any money you borrow against in the back end in your piggy bank, you're still earning interest and potential dividends. That is happening. It's guaranteed. Remember the schedule. The interest still comes back to you and it doesn't go to the bank. So, as you are a part owner of the insurance company, when you pay the interest back to the insurance company, right, from the loan that you took, that is now one form of the insurance company receiving profits. And then when at the end of the year, when the insurance company has to declare their profits, it will distribute that to the participating policy owners, and it will allow you to actually get back some of that money in the form of a dividend, as well as the other investing that the insurance company does. Okay, so your wealth keeps growing despite borrowing from it. Policy loans are tax-free. Okay, and when it comes to repaying the loan, you operate as your own banker and you set the payment schedule. So in case of an unpaid loan, the amount will be deducted from your death benefit. So if, let's say, for example, you have $200,000 death benefit and you've taken out $100,000 and you pass away, so your beneficiary will get the $200,000 minus the loan of 100,000, and then they will be given the remainder of 100,000. Okay. As well, when it comes to repaying the loan, you're your own banker, so you don't have to worry about, hey, I missed a payment or two, like my house will be, power of sale or foreclosure, or my car will be repo. Let's get into that some more. So let's give an example of a policy loan for a car. Traditionally, if you want to get a car, we are taught that there's only 3 ways to do that, but there is a 4th way, and that's using your own banking system. So 1, you could either finance, 2, lease, or 3, pay cash. And a lot of people will do any one of these. They're not aware of the 4th one. And people feel really good. Oh, I paid cash. I have no payments for that, right? And I'm not saying that's a bad thing, but remember Nelson Nash said, the writer downer is if you pay cash, you're losing that opportunity cost, like the opportunity to gain the interest and the dividends. So let's look at each of these ways and the limitations and why a policy loan is the best way. So 1, you finance a car, you apply for a loan, you jump through the hoops, you seek their approval, then you get the car, you continue to pay the loan to the traditional bank. The bank controls the process. It controls the rate, how the interest will be, how the repayment schedule will be, and you become the owner of the car, but all the money has gone to the bank with interest, and it will never be yours again, that money. It doesn't stay in your banking system compounding and gaining interest. In the event something happens to you and you can no longer repay the loan, I don't really think they're very sympathetic. The bank repossesses your car and you end up losing the money that you had already paid. And in some cases, you have to pay them still more money, right? Because the car has depreciated. All right, number 2, leasing. So you can use a car, but it's not yours. You don't own anything. You are always in debt, and the money in your account just keeps decreasing. It's going away to somebody else. Now, cash. This is the one where, you save up your money to buy a car. You feel good. You go to the car dealer like, hey, I got this lump sum of cash, and then you take the cash from your bank, you transfer it over to the dealer, and then your account is back at 0. And if you want another car, you have to save up again, pay the remainder, and give it to them again. And your account is at zero. So you lose the opportunity, which is so important. Like, we're either going to finance and pay interest to somebody else, or we're going to lose that opportunity to gain interest on our money. And the money is transferred to another person's account. So this is the other way. So has anybody ever heard of doing a policy loan for a car? Let's see in the chat. Anybody ever heard of doing a policy loan for a car here? Okay, no. All right, awesome. Okay. Has anybody ever paid cash for a car? Can I see in the chat if anybody's paid cash for a car? Or why don't you put into the chat what kind of ways do you guys usually pay for cars? Do you pay cash? Do you finance? Do you lease? I think I've done all. I haven't done leasing. I've done financing and I've done cash before. I know a lot of people that have businesses, they like to lease and stuff like that too. Okay, awesome, awesome. So let's go into the next way to do it, the one that's not too popular, policy loan. So even though you pay cash for your car to the dealership, in the real sense, you obtain the financing for purchasing by borrowing against a cash surrender value in your funded policy. So what happens is you build it up, right? Inside your policy is growing and you have enough money to take a policy loan. But to play an honest banker, you have to start making monthly car payments to the life insurance company, because that's where you borrowed the money from. That's where you took the policy loan. That's where you got asked the two questions. How much do you want and what account? Okay. So if you had borrowed from a traditional lender, you had to repay them with standard interest rates. And the interest you pay still belongs to you, or will come back to you, because you get daily interest anyways on the money that's in the back end, and you get that dividend, right? And it all belongs to you. And if you fail to make the full repayment right away, or you miss a couple of payments because of hard times, the insurance company will not come and repossess the car, because the car is not the collateral in the policy loan. The cash value of your insurance policy is the collateral. So if you fail to make a payment, they don't really care, but it's for you to be the honest banker. Okay. Just like you would pay the other, the other institutions, then you need to pay yourself back with interest. Okay. So suppose you begin implementing IBC in your personal life and you're making large premium payments to a properly structured participating whole life insurance policy. When you want to buy a car, you don't have to rely on financing from a dealership or external lender. This is where we're talking about those who have the gold makes the rules, because you're building up the gold in your own system. So rather than taking money from the traditional institutions, you take a policy loan for $25,000 and you pay the full purchase price to the car dealer to acquire the car immediately. All right. And then once you do that, you start making your payments back to yourself. And at the end of, let's say you did it for 5 years, making payments back to yourself with interest, you have the car, and then you have, you've repaid the $25,000 back to your banking system that you can reuse again to purchase another car. Okay. So advantages of infinite banking. The number one advantage is it's a way to create a financial source by funding your own future loans while building an inheritance for your loved ones in the form of a policy death benefit. So you're able to do all the financing that you usually do and also look after your loved ones. It allows you to pay yourself back using your own terms and pace, and there's no set amount of interest or repayment schedules. You decide. I know a lot of people that they say, if I'm going to pay myself back interest, I might as well pay myself back more interest because it's coming back to me anyways. And they just have a standard 10%. on everything that they finance. But they can also stretch out the amortization period to make those payments reasonable for themselves and to make the the cash flow more reasonable for themselves. So interest rates are also generally lower compared to a conventional bank, and they're at simple interest. And you can lend money from your cash value to your family or your friends or your loved ones. I would definitely recommend using a lawyer because, money's money here. So we got to be due diligent if we're going to lend money out to people. The cash value of your policy keeps growing in the entire lifetime of the policy, even while borrowing. So your borrowing doesn't affect the growth of your cash value. That thing, when it starts to snowball, it starts to take off, as you saw in the illustration previously. And loans, withdrawals, and dividends are tax-free. There's no credit check required to be allowed to borrow. Remember, I said 2 questions. What account? How much? Very easy. And you may borrow for any reason. You don't have to explain what the funds are for. You don't have to say, oh, it's for renovations. Oh, it's for this. Those are not questions that are required because it's a solid asset. Now, there are disadvantages of infinite banking. Let's talk about those. So the monthly premiums are high. They're higher than term insurance because we have to take into account that this is for your whole life. You are protected for your whole life, right? So they are going to be higher because term insurance is for a term. And as the term expires, that term insurance then becomes higher and larger. So this just takes into account that we're doing it for the whole year and we're just kind of averaging what it would be for your whole life. All right. Now, in case you fail to repay the loan, which could happen, the amount that you have borrowed will be deducted from the death benefit, and that means that your beneficiaries will receive a less amount. But that's fine. I mean, I know people that they take policies for themselves, then they also take policies on their children, right? And they use both. They use their policies, they use their children's policies, and then they designate in clear terms to the lawyer that once I pass away, I want my proceeds from the policy, whatever's left after my loan, to pay off the loan that I took on my child's policy on their banking system. Now my child can continue to make those annual payments, and their policy can grow uninterrupted, and they'll have like a substantial amount of cash. And now let's say they're putting in $1,200, but they're really getting back in dividends alone $5,000 because that policy has been growing. So that is another disadvantage, is that they would get less, but you just have to structure it properly. Now this one, qualifying for a new whole life insurance policy may be difficult for older people or for those with poor health. So, there are senior citizens or people very, very poor health that will get denied. But you do need to try to put a policy on yourself first, just like as if you're in an airplane and, you're with your children and the mask drops down. They always say that put the mask on yourself first, clearly, because if something were to happen to you, you're not going to be able to mask up the rest of your children. So you put the air mask on yourself, the oxygen mask on yourself, then you put the oxygen mask on your children. Okay, so we want to put it on ourselves first. If we don't get the coverage, then we can put it on the younger people. And again, you would be the owner of that banking system on the younger child or on, your grandchild. And you would be able to grow that policy. And once you do pass away, you can leave it for them to continue to grow it. So investing in kids early is very important after you've taken care of yourself. So according to Nelson Nash, there's a great value in purchasing policy for kids as early as possible because these policies get to start snowballing really early. Okay, so these policies are permanent. and there's guaranteed coverage for the rest of that child's life. And the child, they'll enjoy a lifetime protection of life insurance, regardless of changes in their occupation or health, or as long as you pay your premiums, they will be covered. Now, by purchasing a whole life policy for your children, you prepare them for financial freedom in the future. So by the time the kids have grown, gotten employment, they would have amassed a huge cash value that will enable them to retire with passive cash flow, tax free. And I'm going to be honest with you. I was like to my mom and dad, like, how come you guys didn't know about this? Why don't I have a policy that should be in effect when I turn 65 and that I can get my passive cash flow? So Nelson Nash did an example, and it was for some grandparents, and they didn't qualify, so they put it on their grandchildren. So they funded that policy $2,000 every year for 20 years. So that's 40 grand they put in. 2,000 times 20 years, 40 grand total investment. They were using the policy. They were paying it back. And then that was all that they invested, just a 20 pay for 20 years, and they were done. Now, I don't know if you guys can tell me, but does the RESP do this? By the time those children were 67 years old, they were able to take $222,000 every year, tax-free, passive, cash flow. $222,000 every year for the rest of their life because of that $40,000 investment that kept on compounding in the back end in that vehicle, in that piggy bank. Okay, so investing in children early after you've taken care of yourself is vital. Now, frequently asked questions about IBC. How soon can I take a policy loan? So with a policy that's properly organized and structured and focused on high growth, you can take a policy loan within 1 month of starting your policy. Why are mutual companies recommended instead of stock companies? So mutual life insurance companies work for its policy holders, while stock insurance companies are focused on shareholders like the stock market, appreciation for the benefit of the shareholders. Whole life insurance policies and mutual insurance companies enjoy some ownership rights, which is not the case with policy holders in stock insurance companies. And also, most participating life insurance policies are found in mutual insurance companies. So why should I use whole life for IBC and not index UL, which is a universal life policy? So the premium on whole life policies are fixed. I really like that. It's like having a mortgage that you know that the payments are fixed for the rest of your life. And as you age, the premiums they remain the same, right? So as inflation goes up, you still are paying that same payment. With Index Universal Life, the premiums are not fixed. It's kind of like a variable, but not, you know what I mean? As you age, the insurance cost goes up. So how do I repay the policy loan? With whole life policy loans, you determine your repayment schedule and payment amounts. But mind you, you do want to be an honest banker. You don't want to be stealing from your own banking system. This is your business. You wouldn't steal from, well, you would get bad credit if you don't pay back the banks, right? So think of it like that. That's why you want to pay yourself back. All the loan repayment terms are flexible and are determined by you. So you can decide, maybe I want to take a policy loan that's the size of my mortgage, drop it down, pay the bank off, and now I can redirect those payments back to myself, back to my policy. And I can determine, maybe I want a 50-year amortization period, or maybe I continue paying the same amount that I was paying to the insurance company. Why not? I was paying them for the next 30 years. Why don't I pay myself back for the next 30 years? Okay, so let's keep going. So how soon can you borrow against a life insurance policy? So you can borrow from a life insurance policy as soon as there's enough cash value built up to take a loan in the amount that you need. Depending on how your policy is structured, this can take some time to build up the funds. So for example, let's say you go to Fido, TELUS, or any of those cell phone companies, and they have phones that they will, oh, you only got to pay an extra $20. to get this phone. Why don't we take a policy loan from our policy? We can pay, the $1,000 to the cell phone companies, and then we can make those payments back to our policy instead of making it to them every month, right? So there's ways that you have to think creatively on how to become the banker. All right. So becoming your own banker. This is the book that changed my life, guys. So I would highly suggest getting a hold of this book and going through it bit by bit. We have a way to do that, instructions on how to read the book best and most effectively and efficiently. So if you just go to https://www.becomebankers.ca/BYOB. That's BYOB for becoming your own banker. We're going to put that in the chat for you. And yeah, get this book, and it changed your life, and it can change yours. So not only did it change my life, it can change yours. Whatever it did for me, it can do it for you. Anything that has transpired for me, which has been amazing, this can also work for you. Okay. So you can now, what I would like you to do, if you want more information about this, please schedule a call. Text the word schedule to the number below, 866-722-2653, or email at ibc@pbbankers.com to get more information. And we can go over it with you personally to see how this can fit in your life, right? All right. And again, if you guys want any more information, I would love for you guys to just text or, email, but you can text 866 PB Bankers. I mean, some of those numbers will get dropped off, but that is the number, 1-866 PB Bankers. Okay. So just text us and we'll get you more information, or you can email support@pbbankers.com. Okay. So thank you so much for staying on here, and I look forward to talking to you guys more in depth. I hope you enjoyed it, and I hope that this was enough information for you guys. Again, you can check in the link here. There's also a calendar app, so you guys can book there. Yes, thank you so much again, everybody. Thank you for being here, and I'm excited to hear from you guys, and I hope you enjoyed it. So have a great day. I'll just give you guys some minutes to copy the calendar link or the book link there, the becomebankers.ca BYOB. So yeah, again, Infinite Banking changed my life. If it did it for me, it can do it for you. It definitely is a game changer. So yeah, get involved. And congratulations, Kevin. All right. So yes. Thank you, guys. Thank you. We'll definitely be sharing some more information later on about infinite banking and the different ways to be able to use it. So look forward to that in the new year, guys. So thanks again.